Bitcoin trims losses after core CPI rises less than feared 0.2% in May. That single number resets the market's playbook. The key question is not what happened, but what changes next for operators and users. We will map trigger, incentive shift, and downstream impact before the close. And in that single data point, Bitcoin just avoided a major sell-off that was looking increasingly likely. Let me walk you through what happened, why this number matters far more than most investors realize, and what you should be watching over the next 72 hours. The setup was straightforward but brutal. For weeks, markets had been pricing in a scenario where May core CPI would come in hot. If it did, the narrative would have shifted hard, rate cuts delayed, Fed staying higher for longer, and risk assets, especially volatile ones like Bitcoin, would have faced significant downward pressure. Traders were already positioned defensively. The fear was real. Then the data dropped. Core CPI rose 0.2% month over month. That's the smallest monthly increase we've seen in months. And crucially, it's 0.2 percentage points below what consensus expected. This is not a miss by 0.01%. This is a material beat that changes the Fed narrative in a single release. Here's why this matters beyond just Bitcoin. The Fed's entire policy stance depends on whether inflation is actually cooling or whether it's just been artificially suppressed by base effects and transitory factors. If core CPI is genuinely trending down, and this data suggests it is, then the case for rate cuts becomes materially stronger. Not by September, necessarily. But the trajectory shifts. The Fed doesn't have to hold as long. The terminal rate might actually be lower than current market pricing. For Bitcoin specifically, this is enormous. Bitcoin is a duration play. When real yields fall, when the opportunity cost of holding zero-yielding assets drops, Bitcoin becomes attractive again. When inflation fears ease and monetary tightening is no longer the dominant macro story, capital flows back into riskier assets. Bitcoin rallies. Not because the underlying technology changed, but because the macro incentive structure just shifted. Now here's what most investors are missing: the single data point doesn't guarantee a trend. 1 month of cooling inflation is not a policy shift. The Fed won't react to one CPI print. What matters is the next 3 prints. If June, July, and August also come in cooler, then you're looking at a genuine regime change. The market will start pricing in rate cuts. Real yields will compress further. That's when Bitcoin moves from tactical relief bounce to sustained rally. Conversely, if next month core CPI bounces back up, all of this relief evaporates. Bitcoin rallies into selling. The question shifts back to when does the Fed cut, and the answer becomes much later than we thought. Positions reverse. This is a critical fork in the road. The contrarian angle here is worth examining. A lot of macro traders have been waiting for CPI to roll over before going long duration. This print is their signal to start that trade. But here's the thing, everyone knows that. The algos are front-running it. The smart money has already started repositioning. By the time retail gets the narrative, the best entry might have passed. This bounce in Bitcoin could be a head fake if the data doesn't confirm over the next 2 months. What you need to monitor over the next few days: first, watch Fed speakers. Janet Yellen, Chris Barkin, Loretta Mester, they'll all speak within the week. The tone of their remarks will tell you whether the Fed is actually shifting its stance or whether they're going to push back on the rate cut narrative. If they say the data is encouraging but not decisive, that's a signal that one print isn't enough to change their minds. If they sound dovish, the rally accelerates. Second, watch Treasury yields. If the 10-year yield drops significantly below 4.2%, that's a signal that real yields are compressing and the macro backdrop is genuinely shifting. Bitcoin tends to track real yields pretty tightly over monthly timeframes. If treasuries roll over, Bitcoin follows. Third, watch the dollar. A weaker dollar makes sense in a lower rates scenario. If the DXY index starts trending down, that's confirmation that the entire macro framework is shifting from tight financial conditions to easier conditions. That's when Bitcoin's rally becomes a conviction move rather than just tactical relief. The practical implication: if you've been waiting for confirmation that the rate hiking cycle is actually over, this is the first real signal. Not proof. Signal. The burden of proof falls on the next 2 months of data. But the probability distribution just shifted. Tail risks to rate cuts got smaller. That changes positioning across the entire market, not just in crypto. Here's what changes next. Over the next 72 hours, expect volatility as macro traders digest this print and reposition. Then we wait for Fed speakers to either validate or reject the dovish interpretation. Then we get producer inflation data. Then we get consumer sentiment. Each of these is a checkpoint. If they all cluster in the inflation cooling direction, Bitcoin's rally becomes self-reinforcing. If any of them surprise hot, the narrative breaks and we're back in the chopping block. This is not a call to go all in on Bitcoin. This is a call to understand what just shifted. The probability of the Fed maintaining this rate level for 6 more months just dropped. That's a material change. Not a guarantee of a rally, but a material shift in the incentive structure. Watch the next data points closely. Core CPI just came in 0.2% cooler than expected. That's the smallest monthly increase in months. It doesn't guarantee anything, but it just killed the bear case that had been pricing in 6 more months of higher rates. For Bitcoin, that's massive. Lower real yields mean the opportunity cost of holding zero-yielding assets drops. Capital flows back into risk. But here's the critical part: this is a signal, not proof. The next 3 months of data determine whether this is a genuine regime shift or just a 1-month anomaly.